Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. The UK's comeback has boosted the performance of the UK Equity Income Investment Trust sector, returning 14% over the last year, an impressive 79% over the last 5 years, and 105% over 10 years. The average UK Equity Income Investment Trust has a yield of 4.1% and is in demand as it's trading at a 3.5% discount in comparison to a 13.9% discount for the average investment trust excluding the 3i. But will the good times continue for the UK equity income sector? Well, I'm delighted to be joined by three managers from this sector. Ian Lance, who's the manager at Temple Bar Investment Trust, Julian Cane, who's the manager at CT UK Capital and Income Trust, and Thomas Moore, manager at Aberdeen Equity Income Trust. Right, on to the questions. Will the good times continue for the UK and your trust portfolio? And I'm going to ask that to Thomas.
Hi, Annabelle. Thanks, everyone, for dialing in. Well, I think that question requires a bit of a nuance because, yes, UK equities are genuinely cheap. And actually, if you look at the price earnings ratio on the UK equity market, it's somewhere between 12 and 13 times. It sits right down at the bottom end of any global markets. You really have to look into the depths of the emerging markets index in order to find any stock market that looks that cheap at the moment. And when you compare that with global stock markets, and in particular the US stock market, that provides some brilliant re-rating opportunities for us. We can find some great companies which are just poised, ready for a valuation re-rating. On the other hand, you did ask, what are the nuances on this question? Well, the UK economy isn't looking particularly happy at the moment. And I'm not going to pretend that it's all rosy, because I really don't think it is. I think the government's got a huge task on its hands to try to steady the finances without causing some kind of rout in the bond market. So, look, it's a difficult conundrum that they're facing. But I think we should definitely nuance the difference there between the economy, which is only a small percentage of the UK market, and the stock market, which can continue to thrive.
Well, I'm really pleased there's some positivity there on the stock market, if not on the economy. Now, Ian, what's your view on this? Will the good times continue?
Yes, I think they will. I would agree with Thomas that the UK market still looks very cheap, and within it, we think that the value part of it is cheaper than it's been for a number of years. I think the more positive thing is that we're now seeing some catalysts to realise that value in the form of takeovers. So lots of US companies seem to have realised how cheap UK companies are, and they are helping themselves to UK companies. And share buybacks. So companies themselves have actually started to buy back their own cheap equity. I suppose the final thing that I would say is that we've started to see money rotate from international markets into the UK, and there is a colossal difference in size. The US stock market today is $70 trillion. The UK is $3 trillion. So you don't need an awful lot of money to go from the US into the UK to have a reasonably significant impact.
Thank you, Ian. So M&A, share buybacks, transfers of money into the UK market. Sounds good. Julian, what do you think? Will these trends continue?
Well, I certainly agree with those comments. I think for many years, of course, the UK stock market has been rather left behind. It's been slightly like the ugly duckling, that the Magnificent Seven, the US market, or more broadly, the international market, which of course is dominated by the US, has taken all the flows. And, over many decades, investors have really looked down their nose at UK companies and seen them as being very poor relations of elsewhere. But many of the companies that we see in the UK are very attractive and are generating good returns on equity, but they don't seem to get the share prices to reflect that. So we think that over time there will continue to be this re-rating of UK companies. There's no reason to stop that. Although, of course, you do have to separate out the UK economy from the UK stock market. But of course, most UK companies are headquartered here, but many of their operations really are truly international.
Well, let's hope that re-rating continues and we can go from the ugly duckling to, a beautiful swan. Let's hope so anyway, in terms of the UK perspective. Ian, where are you currently finding the best opportunities?
A range of areas. We are finding a lot of value in financials. That would be both the banks and the insurance companies. Across some of the consumer discretionary names. So that would be retailers like Currys, for instance, have been doing very well recently. IAG, the airline, has been doing very well recently. And then in more esoteric areas, so Smith & Nephew is a company that we have recently been buying in the health space, and a final one would be within materials. Johnson Matthey is a company, so it's a wide variety of areas across the UK market.
Yeah, a wide variety of areas which are obviously undervalued. Julian, where are you finding your opportunities?
Well, we see a lot of opportunities really pretty much across most of the sectors. In particular, we think there is great value slightly outside of the very largest companies in the index, and those tend generically to be most looked at, most covered by analysts, and most well owned. We do spend quite a lot of time looking at the bottom end of the FTSE 100 and into the mid-cap index as well. And the valuations there are that much cheaper than FTSE 100. So there really are value opportunities, interesting opportunities across the board.
Well, that sounds positive to hear. How about you, Thomas? Where are you finding your opportunities?
Yes, I think you can always say that there's good value, and we're finding lots of value opportunities. The question is, where's the catalyst? And so one of the things we've been working really hard on in the last couple of years is actually, we noticed we could go along to an event like this and we can say, UK is really cheap. And people would answer back, well, look, we get that, but we don't see the catalyst. And I think that there's an element of actually, as active managers, we need to be certainly identifying the value, but we also need to be saying, well, what's the catalyst that's going to drive that re-rating? And so at the moment, where we're seeing that is financials. We're seeing some really good environment. This is a great environment for financials. And if you go back to think about the macro, one of the headwinds for the consumer is sticky inflation. But of course, that's a tailwind for financials, because if you're a bank or if you're an investment platform and you're sitting on people's money and you're earning that little spread, that spread is it sounds not very much money, but actually that net interest margin, the difference between the money they take in and the money they lend is actually staying at really robust levels. So that's a wonderful environment for financials. And then if you think about the reverse of that, actually the consumer environment is very, very tough. So we have to be very selective on that side.
Right. Well, it sounds like financials very interesting here. Now, let's move on to some of the risks that the UK faces. Julian, what are the risks facing the UK in your portfolio?
Well, I think there's perhaps no risk by extrapolation. So most people would say that there are macroeconomic risks. But of course, we've actually seen the stock market performing very well, almost despite what's been going on in the economy. So I'll say it again, that the UK economy and stock market are very different. Nonetheless, at extremes, obviously that is a risk. And I think you would also put geopolitics into that as well. But overall, I mean, it's long been the case that valuation tends to override all of these factors. So when valuation is as attractive as it is for the market, that tends to override most of these other things. Of course, the real risks are often things you can't really predict, COVID, something like that. So one always has to be aware that could be around the corner. But in terms of the risks that we can identify, we think valuation should overcome those.
Okay, well, that's hopeful. We're so attractively valued that hopefully people will be investing with us. Thomas, what do you think the risks?
Yeah, if you have a think about the balance sheet within any economy, you've got different types of debt that builds up over time. And obviously, those of all of us here remember very well the build-up of private sector debt. So individuals were taking on lots of mortgage debt. Do you remember in about 2006, 2007? And then that all subsided. We've got a very different problem now. It's not so much that consumers have got lots of debt, it's that governments have got lots of debt. And that's beginning to ripple right across the UK stock market. So you're seeing the effect. In fact, I've noticed every meeting I've had has had some version of that discussion, that actually the government is running out of cash. We all remember that note in 11 Downing Street that was left for the incoming coalition government back in 2010, which said, there is no money, the cupboard is bare. and that's even more the case now. So actually that will affect lots and lots of different companies. The Chancellor has left it to the last minute to do her budget. She's going to have to find out how she can raise money. And the problem for her is that raising tax rates doesn't always mean raising tax revenues. So we've got to think ahead a bit, and we've got to work out, look, who's going to be under pressure post that budget. And actually going back to the point I made earlier, you know what, we have to find stocks which are cheap, but they can't be value traps. They've got to have catalysts. And so if we can find stocks that are cheap, you know, that aren't necessarily going to be affected. So we're thinking about stocks like Galliford Try, you know, that actually there's a lot of private sector investment in areas like water, which don't depend on the government, the indebtedness coming good anytime soon. So that's where we see the opportunities.
Excellent. Wow. Yes, I can see we've got to really think hard here in terms of where those opportunities really lie in this difficult environment. Ian, what about you? What do you think the risks are?
Let me give you a non-macro one, which is I think that one of the big risks is basically a bursting of the US technology bubble. US technology stocks have gone up a long way for a long time. They now represent a third of the S&P 500. They are, you know, as we all know, investing gargantuan amounts of money in AI with, for the moment, nothing to show for it. And investors have been willing to give them the benefit of the doubt. There's a risk, I think, at some stage that actually investors begin to get a little bit wary of this. They watch the cash burn of these companies, and eventually these share prices roll over. Now, the sort of short-term risk, if you want to call it to that, is that if these things roll over, they're going to take everything down with it. You know, the rest of the world stock markets are not going to sit there in splendid isolation as the US, you know, as the Nasdaq goes down. I suppose the positive side is that actually, well, number one, the UK market is much cheaper than the S&P 500, so you would imagine that it would hold up better. And then number two, it might actually encourage people to think about reallocating money. So for a number of years, people really have seen particularly in the US, have no sense of diversifying. You know, just having 100% of your equity exposure to the US has been the right way to be for a long period of time. If we saw the US technology sector roll over, well, maybe people might start to question that, and the UK might end up being a beneficiary of that.
Well, I mean, we have seen reallocation of capital this year out of the US into Europe, Asia. And so if there's a problem with the Mag 7, hopefully that will actually accelerate.
Absolutely.
Okay, now looking at the investment trust structure, I'm wondering how you're using it to generate strong track records of dividend growth. I'd like to ask that to Julian.
Sure. Well, one of the really fantastic features of investment trusts is the ability to use reserves, particularly revenue reserves, to smooth dividends. So we have to pay, as investment trusts, 85% at least of our net earnings to shareholders in the form of dividends, but we can keep up to 15% each and every year. And over years, of course, that can accumulate and build up to be a useful pot, which can then be used in more difficult times to supplement the income. And that's a power that all investment trusts have and could use. Some have used more than others. And certainly across the 31 years of CT UK, we have built up reserves. Our reserves are almost 90% of the annual dividend. But we have dipped in many times. So across the last decade, we've used reserves 3 times to supplement the income that we've received naturally, and in order to keep our dividend growth going. So it is an enormous strength to have that revenue reserve. And more recently, companies have also been able to use capital reserves to make that distribution. And that really is a big contrast to the open-ended sector. And I think for anyone looking for a steady payment, of course, there are no guarantees, but perhaps planning for a pension, retirement, having that safety net of the reserves to underpin the dividends, I think is a very useful thing to have.
It certainly is a very useful thing to have. And we have 20 investment trusts, which are dividend hero investment trusts, which they've increased their dividend every year for more than 20 years. And of course, your trust with 31-year record of consecutive dividend increases is one of them. So that is a very useful benefit Moving on, Ian, what about you? What do you think are the benefits of the structure when you're generating income?
Very well demonstrated, I think, by this year. The board of Temple Bar decided to change the dividend policy of the trust. And this was in recognition of the fact that an increasing number of companies are now splitting their distribution to shareholders between dividends and share buybacks. And a dividend obviously goes to the revenue account of a trust. A share buyback does not. It goes to the capital account. And so what the board said was that in the future, they are going to pay a certain amount of income out as dividend, and then they're going to supplement that with a payment out of the capital side of the trust in recognition of the fact that an increasing amount of the return to us is coming through share buybacks. And the actual impact that that had was it turned a 3p quarterly dividend into a 3.75p quarterly dividend, and it basically took the yield on the trust up from about 4% to about 5%. So I think that was, quite an innovative way to use the trust structure to ensure that the money is still being returned to the trust shareholders.
Absolutely, and a really quite material impact on the dividend from that. And of course, you couldn't do that with an open-ended fund, could you?
No, not at all.
Excellent. And Thomas, how about you? What do you think are the benefits of the structure when you help you generate income?
Yeah, I'm quite a glass half full person, so I like gearing actually. And I know we do have lots of discussions about gearing, but this is something that you can do in a closed-end vehicle that you cannot do in other types of vehicles. So I think this is a really, really important area where we can add some value. And when I say glass half full, look, I mean, actually, it's not wishful thinking. This is actually based on data that if you go back 5 years, 10 years, 20 years, we talked about the dividend hero status. Look, it's true to say that part of that has been driven really by the stock picking that we've done, but it's also because the market itself is producing this wonderful dividend growth. And so over time, we get dividend growth, we get capital growth. And if we add some gearing into the mix, actually that just propels us even faster. And it allows us to build up more revenue reserves. It allows us to actually take advantage of this positivity that we see in equity markets. I speak to my fixed income colleagues. They just don't have that. Of course, the clue is in the title, fixed, that we have growing dividends. And if we add some gearing in, and at the moment I'm sitting on gearing of about 11.9%. So that's typically we're between 10 and 15%. And so actually, I'm always mindful. We always have the discussion at the board, how much gearing do you think is appropriate given the signals that we're getting on the market, on earnings, on valuations. So it's a thoughtful discussion that we have, but that provides us with a kicker. And of course, we're yielding 6.1% in Aberdeen Equity Income. That doesn't mean that the median company or the average company in the portfolio needs to yield 6.1. Because we've got that gearing, it means that actually we could be looking at stocks with a much lower yield, and overall we're still generating that very nice dividend yield for our shareholders.
Yeah, gearing over the long term is a real boost to performance. And as you've explained, that can be dividends as well as, capital and growth. I'd really like to thank our managers for joining us today. It's been great to hear their views. I'd like to emphasise we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thanks so much for watching.